Good afternoon, ladies and gentlemen, and welcome to Richelieu Hardware's second quarter results conference call. At this time, all lines are listen-only mode. Following the presentation, we will conduct a question and answer session, which will be restricted to analysts only. If at any time during this call you require immediate assistance, please press star zero for the operator. This call is being recorded on July 8th, 2021. Bonjour mesdames et messieurs et bienvenue au résultat du deuxième trimestre de Quincaillerie Richelieu. Présentement, vos lignes sont en mode d'écoute seulement. Suite à la présentation, nous allons procéder à une période de questions-réponses qui sera restreinte aux analystes seulement. Si vous avez besoin d'assistance au cours de l'appel, appuyez sur étoile et 0. Veuillez prendre note que cet appel est enregistré le 8 juillet 2021. J'aimerais maintenant céder l'appel à Monsieur Richard Laure, président et chef de la direction. La parole est à vous.
Merci. Thank you. Good afternoon, ladies and gentlemen, and welcome to Richelieu's conference call for the second quarter and 6-month period ended May 31st, 2021. With me is Antoine Auclair, CFO. As usual, note that some of today's issues include forward-looking information which is provided with the usual disclaimer, as reported in our financial filings. We are very pleased with our second quarter. Our results show strong growth and our financial position remains sound and solid. For comparison, it should be noted that during the same period last year, our sales were negatively impacted by a general decline in business due to the pandemic. Both in the US and in Canada, all our market segments have done very well, whether it be the kitchen cabinet manufacturers, architectural millwork, and the residential and office furniture. We are particularly proud of the solid growth in market where we recently made acquisitions and product innovation, such as door and window manufacturers, closet manufacturers, and glaziers. Our hardware retailers market also showed strong growth during the quarter. Thanks to our outstanding website, our one-stop shop approach, and our interconnected North American network that enables us to make product available to our customers in a timely manner and provide alternatives when needed. As a result, the sales increase combined with cost control have positively impacted our profit margins, where we posted an EBITDA margin of 16.4% during the quarter. With the strength of our business model, the quality of our team, and the ability of our organization to carefully adjust to market conditions and be proactive, we were able to provide the best possible support to our customer circumstances. During the period, we also successfully pursued our acquisition strategy and seized good opportunities, meeting our criteria of complementarity, synergy potential, and long-term value growth. We completed 3 acquisitions in the last 3 months, the latest on July the 5th. As mentioned in our previous release, on April 5, we acquired the shares of TAS Tools, a distributor of power tool accessories and related products serving the hardware retailers market in Canada and in the US. We also signed 2 agreements in principle, one of which was completed with the acquisition of Oscan Industrial Fasteners Limited on June the 1st. Oscan is a leading importer and distributor of screws, bolts, and industrial fasteners, operating a distribution center in Montreal, from which it supplies hardware retailers mainly in Eastern Canada. On July 5, we acquired 75% of the shares of Interco Inc., a distributor of Division 10 products for the construction industry in Canada and in the US, operating 2 centers in Ontario and 3 in the US, in Arizona, Ohio, and Texas. Interesting to note that this acquisition will be combined to one of our divisions already operating in this sector of activity and covering Western Canada. In addition, we signed another agreement in principle for an acquisition in the US. Altogether, these transactions would add sales of $73 million on an annual basis. I will now go to Antoine for the financial review of the period.
Thanks, Richard. Second quarter sales reached $371.4 million, up 49.6%, of which 46.8% from internal growth and 2.8% from acquisition. At comparable exchange rate to last year, sales increase would have been 56%. Those increases are the result of the strong demand in the renovation market compared to last year, where sales had been negatively impacted due to the slowdown in business resulting from the pandemic. In Canada, sales amounted to 248.1 million, up 59.8%, of which 56.7% from internal growth and 3.1% from acquisitions. Our sales to manufacturers reached 203.7 million, up 63.5%, of which 61.7% from internal growth and 1.8% from acquisitions. As for the hardware retailers, sales stood at 44.4 million, up 45.1%, 37.4% from internal growth and 7.7% from acquisitions. In the U.S., sales grew to $99.4 million in US dollar, up 49.5%, 47% from internal growth and 2.5% from acquisitions. As in Canada, the renovation market in the United States has been growing strongly. Sales to manufacturers reached 87 million in US dollar, up 52.6%, 50% from internal growth and 2.6% from acquisitions. In the hardware retailers and renovation superstores market, sales grew by 30.9%, mostly from internal growth. Total sales in the U.S. reached 123.3 million in Canadian dollar, an increase of 32.6% and representing 33.2% of total sales. For the first half of 2021, sales totaled 669 million, up 34.4%, of which 2.5% from acquisition and 31.9% from internal growth. In Canada, sales reached 441.3 million, up by 129.4 million, or 41.5% of which 39.5% from internal growth and 2% from acquisition. Sales to manufacturers reached 357.3 million, up 104.8 million, or 41.5%, mostly from internal growth. Sales to hardware retailers and renovation superstores reached 84 million compared to 59.4 million, up 41.4%. In the U.S., sales amounted to 181.3 million in US dollar, up 32.5%, of which 28.8% from internal growth and 3.7% from acquisitions. They reached 227.7 million in Canadian dollar, up by 22.6%, accounting for 34% of total sales. Sales to manufacturers total 156.1 million, an increase of 38.5 million or 32.7%, of which 28.5% from internal growth and 4.2% from acquisitions. Sales to hardware retailers and renovation superstores were up 31% compared to last year. Second quarter EBITDA reached 61 million, up 27.2 million or 80.5% over last year, resulting from significant increase in sales and continued control of expenses. Gross margin improved slightly and the EBITDA margin stood at 16.4% compared to 13.6% last year. First half EBITDA reached 99.1 million, up 69%. As for the EBITDA margin, it stood at 14.8% compared to 11.8% last year. Second quarter net earnings attributable to shareholders totaled 37.4 million, up 111.4%. Net earnings per share were 67 basic and 66 cents diluted compared to 31 cents basic and diluted last year, an increase of 116.1 and 112.9% respectively. First half net earnings attributable to shareholders reached 58.4 million, up 98.1%. Diluted net earnings per share stood at $1.03 compared to 52 cents last year, up 98.1%. Second quarter cash flow from operating activities before net change in working capital balances amounted to 46.5 million or 82 cents per share, an increase of 74% compared to last year, resulting primarily from the net earnings growth. For the first half, they were 63.2%, totaling 76 million or $1.36 per share. For the second quarter of 2021, financing activities used cash flow of 6.7 million compared to 3.8 million last year. Dividends paid to shareholder of the corporation amounted to 3.9 million, while no dividend was paid in the corresponding quarter of 2020. First half financing activities used cash flow of 22.4 million compared to 10.6 in 2020. Dividends paid to shareholders amounted to 11.6 million compared to 3.8 million last year. In the first quarter of 2021, a special dividend of 6.67 cents per share was paid in addition to a quarterly dividend of 7 cents per share. We also repurchased common share for an amount of 3.3 million in the first half of 2021, while no share repurchased in 2020. During the second quarter, we invested 13.9 million and 16.7 million in the first half, of which 9.8 million for business acquisitions and 6.9 million primarily for the purchase of equipment to maintain and improve operational efficiency, including the addition of IT licenses. We continue to benefit from a healthy and solid financial position, cash balance of 89.6 million, almost no debt, a working capital of 416.3 million for a current ratio of 3.7 to 1, and a return on average equity of 20.4%. I now turn it over to Richard.
Thank you, Antoine. In conclusion, our value-added service concept remains the cornerstone of our leadership. It's based on innovation in product offering, the most diversified and complete offering in our market, covering the widest range of specialty product categories. On simple and easy access to our products, whether through our network of one-stop shop centers, and through our trilingual website, richelieu.com. On the quality and reliability of our service, and the broad range of unique sales tools in our market that we provide to our customers. Our decision to maintain our inventory level at the beginning of the pandemic showed to be the right decision, and our customers are still benefiting from it. We continue to do our utmost to support them. We expect our manufacturer market continuing to be strong. To this end, in anticipation of strong future growth in the U.S., and in order to meet demand and provide the best possible service, we have several expansion projects on the table for some of our U.S. centers, notably in Detroit, Atlanta, Dallas, Boston, and Orlando. In addition, we will open a new center in Pennsylvania, likely at the end of the third quarter of 2021. As for the sales to hardware retailers market, we do not expect growth in the second half, given the exceptional sales in the last two quarters of 2020. However, compared to 2019, retailers market should show a very healthy growth and should continue to be strong in the coming quarters. We remain highly vigilant to market conditions and closely monitor prices and worldwide transportation cost increases. If necessary, selling prices will be adjusted accordingly. We are confident in Richelieu's strength and great potential to continue to grow in the coming period and execute its strategy in order to create long-term value. Thanks, everyone. We'll now be happy to answer your questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session for analysts only. Should you have any questions, please press star followed by 1 on your touchtone phone. You will hear a 3-tone prompt acknowledging your request, and your questions will be pulled in the order they are received. Should you wish to decline from the polling process, please press star followed by 2. If you're using a speakerphone, please lift your handset before pressing any keys. One moment for your first question. Your first question comes from Hamir Patel with CIBC. Hamir, please go ahead.
Hi, good afternoon, and congratulations on a strong quarter.
Thank you.
Richard, I wanted to follow up on the point you made about retailers. I think you said you didn't expect growth, but should still be up healthy versus 2019. Obviously, clearly it will be year-over-year down, but any sort of order of magnitude on, at least compared to the elevated 2020 levels, we should expect for the retailer category in the back half of the year?
Yes, I think if you remember well, in the two last quarters, the sales to hardware retailers increased by something like, correct me if I'm wrong, Antoine, something like 40-45%. So it could be very hard to surpass that. So we compare ourselves with 2019, and we expect the growth to be in the high double-digit growth still in the last two quarters compared to 2019.
Okay, no, that's very helpful. And then, Richard, anything you could share on how June has fared for sales in the manufacturers category?
The manufacturers category is still very strong. It continues about at the same pace that you've seen the second quarter. And then we expect that to continue on for at least for a few months because actually we think there is a lot of cash in the market. The consumers have been piling up cash, both in US and Canada in the last year. And also many projects have been delayed because many people that had projects for renovations like kitchen cabinet or closet had to delay their project because they can't find a contractor to do the job. So it's postponing some work. And I guess with the cash available in the market and the feeling that we've got from our customers, because we are in constant discussion with our customers, we expect them to be very busy still for a few months.
Okay, and then Richard, just coming back to the retailers market, other than obviously the tough year-over-year comps, we've seen signs of the DIY segment slowing in recent months. Have you seen something similar for your products, or has there been maybe differences in terms of actual products impacts on DIY? Yes,
compared to last year, we see it. We also see that some of the retailers, when we had enough stock, they have created they have buy more inventory that really needed in order to secure their business there. So that would be it's also creating some delay in the future ordering. And you're right, the consumers buy probably less now that it was certainly less now that they were buying last year. There's no doubt about that.
Great. That's all I have for now. I'll get back in the queue. Thanks.
Thank you. Your next question comes from Megan Annett with TD Securities. Megan, please go ahead.
Thank you. Good afternoon. So looking at the EBITDA margin, a really strong performance there in the quarter. Are there any one-time benefits that you would call out here? And as we think about the rest of this year and fiscal 22, just on an annual basis, can you maybe update your thoughts on where you see the EBITDA margin trending, maybe relative to 2019?
No, Megan, there's no one time in there, but definitely the high volume is favorably impacting the EBITDA margin. So that's the main impact. We're being very rigorous in terms of cost control, but the strong sales volume is benefiting the EBITDA margin, that's for sure. And as for the rest of the year, so it should continue to be a high margin versus last year. So you should, and looking at the future, if you're using the 2019 EBITDA margin, you should see improvement as well, because the 2020 EBITDA margin was not necessarily recurrent, but if you use 2019 with improvement on it, you should be on target.
Okay, and just thinking about input costs and price increases, Richard, I think you touched on this a little bit. So I think we're in a fairly unique environment here where, we've seen costs rise at a rapid pace, but then we're also seeing some relief now on the cost side. So how do you manage pricing with the customer in an environment like this? And do you see any reluctance to purchase from customers in an environment such as this?
Not at all. Our pricing regarding the hardware product, I would say that since 2019, the price has increased by roughly close to 10%, which is far from being the increases that we've seen for the lumber, for example. So basically, in the actual situation, we keep a very close eye to the whatever is happening to the market for our products. So the way we manage our pricing is to protect our gross margin as a percentage. So if we have cost increases and freight increases that we expect to continue on forever, we change our pricing immediately. As far as the manufacturers are concerned, it takes 24 hours to change our pricing, except for maybe 20% of our customers that are on quotation. And for the retailers, usually it takes between 60 days and 90 days, which is normal with that type of customer. So basically, you can be assured that our gross margin as such is very well protected.
Okay, and just last question. So in light of some of those global supply chain challenges, can you just talk about your approach to inventory management? Are you seeing any challenges there in sourcing key products? And then, as we see some of that slowdown take place, or maybe more of a normalization with the retailers, how do you plan for that from an inventory standpoint in terms of your purchases?
In the today's circumstances, as we speak, we getting our product, into the North America when it comes from Europe and Asia is a challenge. We have a allocation for containers, for the extra containers, because we have a lot of extra containers. We pay a higher price. Some of it we can transfer to the selling prices, but some we don't. But whatever, we do not neglect any possibility in order to have a better service for our customers. So we pay the high price if we have to pay to bring the containers in, and we even pay air freight if necessary to maintain whatever it is necessary. So basically, those extra expenses though are largely compensated by increased sales, as you can see, in our last quarter financials, and we expect that to continue on for a few months. And I say with the small decrease, the decrease that we see as we speak now with the hardware retailers, it will probably create an impact that in 2 months, 3 months from now, we might have a little bit more inventory that would be needed, but we don't see that as a problem. For the manufacturers, though, we expect the growth that you see now to continue on for maybe not forever, but for many months.
Great. Thank you for all the color.
Thank you. We have a following question from Zachary Evershed with National Bank. Zachary, please go ahead.
Thank you. Good afternoon, everyone. Congrats on the quarter.
Thank you.
So you've got a great pace of M&A set up thus far in 2021. Can you tell me a little bit about the pipeline and if you think you can keep up that pace?
I will let Antoine complete my comments, but we're very proud with the acquisition that we made so far. As we already discussed in the previous months, we see that more people are willing to sell their business for whatever reason. I think the pandemic is just another storm in their lives. I think maybe they had enough storm in their life with the downturn businesses that we had before, and some will sell also because they have a good year. So since they make a profit this year, they said, okay, now it's time to sell the business. So because of that, we even though the multiple would be basically the same, so we're going to pay a higher price because they do more profit this year. But that's not a problem for us because it does not represent material differences in the price that we would have paid without the pandemic. Antoine, would you add to that?
No, you're right. The pipeline is very healthy in Canada and the U.S. On the retailers market and manufacturers market as well. So we're very busy. We're working on nice opportunities as we speak. So you should be hearing from us in the next few months.
Yeah, and we have other opportunities coming.
Great news, thanks. And you've really got cash burning a hole in your pocket at this point. Any plans for a substantial dividend hike or more significant activity on the NCIB?
It's a very good question. We ask ourselves the same question. We don't know. We never did something like that, and it's not the first time that we are in a cash position like what we see now. Depending, our priority will remain the acquisition and Antoine, what would you add to that?
Yeah, definitely. Acquisition is the priority. We have a share buyback program in place as well, so there are a few options to use this cash.
Great color, thanks. And then in terms of the expansion in the U.S., what kind of expenditure do you expect over what timeline?
Actually, the expansion that we're doing, the trial is in process now. It should be completed at the end of August. When completed, if we don't encounter any procurement problems or whatever, the racking that we needed, that type of thing, we never know what's going to happen in these days. So the trial we're going to go from 50,000 square feet to 140,000 square feet. We used to be only 50, but we had to pay for exterior, warehouses that we will have the possibility to eliminate now. Atlanta is going to go from 50 to 150. Our management team over there, with all the projects that we have, justified to us, a good business plan that will largely, compensate in increased sales, the investment that will be required to install ourselves in that warehouse. And actually, we're opening a new warehouse. Also, we'll be opening a new warehouse in Pennsylvania. So we service the Pennsylvania market from our New Jersey warehouse. Our New Jersey warehouse actually, is packed to the roof. It's over capacity, so that will give a relief to New Jersey and give us the opportunity to expand our sales in Pennsylvania. And the other projects are Orlando, Texas is already done. We went from, I don't remember what, Antoine, from 40 to 80,000 square feet.
Yeah, like no, Dallas, we went from 45 to 70,000 square feet.
Okay. So basically, all this project we're working on now and should be completed. Many of them will be completed before the end of the year.
That's great, thanks. And then just one last one for me. We've already talked quite a bit about margins on the call, but could you help us break out how much is really torque on the higher top line, and how much is a reduction in your overall central cost structure? And there's also some gross margin left in there. Is that correct?
Yeah, slight increase on the gross. Basically, the EBITDA margin on a normal volume would be somewhere between 12.5% and 13%.
Makes sense. Thank you very much. I'll turn it over.
Thank you. Your next question comes from Robert Currie with Louisburg Investment. Robert, please go ahead.
Hi, guys. Great quarter.
Thank you.
Just wanted to ask a few questions on some mix changes that may have happened over the past little bit, just to kind of recalibrate, if you don't mind. So when we look at renovation versus new builds, you guys have usually been 3/4 renovation, quarter new build or something like that. Has that changed at all, or are we kind of seeing a similar, over the past several months as things have ramped up?
That has not changed. But both the sales to hardware retailers are really related to renovation, as well as the kitchen cabinet and the closet manufacturer. But we see actually more sales to the new construction. It doesn't change the percentage as such, but we see more and more higher end houses and condominium being built. And those, I was reading lately that some statistics saying that on the new construction, the cost for the kitchen cabinet is something like 4%. So if you buy a new house for $1 million, which is high-end, quite a high-end house, so the kitchen cabinet would be worth $40,000 minimum. While in a new construction for a house that sells for $200,000, both the bathroom and the kitchen cabinet will account for only 4%. So it's $12,000. So in the $12,000 kitchen cabinet and vanity in your bathroom, and so you cannot, at this price, you don't even have anything in your closet except whatever is needed to hang your clothes. So basically, it's only $12,000 for that. It's really minimal. So that does not require many Richelieu products to achieve such a project. But usually, in a new house, even though it's a house that is worth $200,000 or $250,000, people will do renovation 5 years after they bought a new house. So that brings some market for the future for us as well and our customers.
Right, that's helpful. Then, just thinking about your mix, you guys have talked before in the past about how some of your U.S. business is a little more commoditized when you compare it to your Canadian business in terms of the actual products being sold. And you guys have mentioned the goal being to try to change that, the attitude in the U.S. to want more premium product. Has that been also playing a part here?
It's moving forward, actually. Our product mix in the U.S. continue to improve, and it's actually, the EBITDA margin in the U.S. is not very far from the one that we have in Canada. And so basically, our exclusive product, as we already said, that 60% of the product that we sell are either exclusive or Richelieu brand name products. And we see all those products actually being very attractive for the U.S. market. Richelieu is becoming more and more well-known. And also, I think the COVID situation also was a springboard for Richelieu to attract new customers, new calls for people that were not contacting us before. So basically, I think the investment that we're going to make in the U.S. are going to open, the growth for a more important growth in the future that we've seen in the past.
Yeah, that's actually a good segue into the next question on when you think about the U.S., you look, or even Canada as well, but looking at market share versus just torque in general, how would you guys break down your growth in the past few, very strong quarters in terms of actually winning market share versus versus general market growth? Obviously, you don't need to give me specific numbers, but just kind of general ideas.
I would say it's 80%, market growth and 20%, new market penetration.
Last question I have for you here is just on, I want to kind of paint a scenario for you, and I'm curious if you kind of give me some guidance. I just want to think about the operating leverage within your business, just given, the gross margin. If you were able to double your business over the next 5 years in terms of top line, similar gross margin profile, so like products are very similar to the mix you have right now. Where do you think your actual EBITDA margin could go from here? Is it kind of top out at close to 20%, or if you even tripled your business from here, like, could you actually see your margin getting up higher to that like 30% margin, or do you think that being below 20 is kind of, that's really where you're, because it's a capital light business, it's kind of where you're probably going to max out at? Just curious if you could provide any kind of clarity on where the potential margin profile of the business really is. Just seeing like this quarter, seeing such a big jump in margin, I'm just trying to understand how much of that is really available as you guys continue to grow over the next 5 to 10 years.
If we continue to grow, there's no doubt that our EBITDA margin will continue to grow as well. Will that reach 20%? That will be a dream. It's like, if you were following up on us since a few years, I keep seeing the investors, my dream is to reach a 20% return on how do you call that, Antoine, on the, as you announced a few minutes ago.
The average, the return on average equity.
Average equity. So basically, I think it's an amazing number, and I think the EBITDA margin. I think if we dream of increasing our sales, depending on the type of investment and added expenses that would be needed to achieve it, I think the EBITDA margin could be close to 15%. I don't know. It's hard to tell that, because let's say if we don't do anything, we just increase our sales, not making any further investment, staying as we are now, we will certainly reach 20%. Yes, no doubt. But to get that $1 billion additional sale will certainly require extra expenses and acquisition with lower EBITDA margin that will dilute the actual EBITDA margin that we're achieving, that type of thing. But we're all dreaming that, our dreams all together, is to increase that EBITDA margin. Yes, no doubts.
Yeah, I mean, obviously you guys have been around for a while, and you guys have an excellent track record, but you're still relatively small. So I'm just, I'm kind of assuming that there's still quite a runway left of acquisitions and internal growth just in general. So I'm just trying to size up what the, a lot of companies, it just seems like they can have margin expansion forever, but at one point it's got to stop. And I'm just wondering where that stop is for you guys, and what your real level of, where it could really go from here. So it sounds like what you're saying is 20% is high, and so, but you could see it, you guys get to more 15% realistically over the next little bit if you kind of continue to grow in the direction you have been. Is that the way I should interpret it?
Does that make sense, Antoine?
Yeah, if you look historically, the highest that we've reached historically is 14.5%. So we were in that area at some point. So
was that pre-IFRS or 16, or is that including
pre-IFRS? Yes, pre-IFRS 16.
Yeah, and that would have been before expanding heavily in the U.S. and then doing all the. I know you guys done a lot of. I don't know how you want to call it, but expansions of your warehouses that have created some headwinds on margin.
You're exactly right. So that's prior to the accelerated growth in the U.S. But now, as you can see, the EBITDA margin is improving year after year. So it all depends on the kind of investment we're making with acquisition, for example. But same store sales, the EBITDA margin is always increasing.
Perfect. It's really helpful. Really appreciate it. Thanks, guys.
Thank you.
Thank you. Ladies and gentlemen, as a final reminder, should you have any questions, please press star 1. It appears there are no more questions at this time. Mr. Lord, you may proceed.
Thank you to all of you. There's no more questions, so we'll always be happy to meet you, to talk to you over the phone if you need more, if you have more questions. Thank you very much and have a very nice day.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating and ask that you please disconnect your lines. Have a great day.